just in terms of disclaimer, look, whatever we discuss is purely for educational purposes. Even if I take any company names, stock names, it is not a buy sell recommendation. It is just my view and opinion on the name, and it's purely shared to you from a education framework construct standpoint. Do not trade or invest based on these opinions, these statements that I make. Do consult your financial advisor.
Am I audible, Sajal sir?
Yeah, loud and clear, please. Hi, Aditya.
Great, sir.
Hi, Aditya.
Hi, Sajal. Bye. Good evening.
Hello.
Hello. Yeah, we can start, sir. Sajal sir, disclaimer on your part also, and then we start with Aditya.
Yeah, no, absolutely. So just like what Aditya mentioned, I can only add that we are all biased. We like what we own. We don't like what we don't own. I'm definitely not your investment advisor. And I don't have any other branch, Telegram, YouTube, etc., etc., and there is never any recommendation. So that's one.
So Aditya sir, we can start around the topic. So opening note from your side.
Yeah, sure. So look, basically what I wanted to sort of chat about on this space is the impact of correcting commodity prices on branded pharma companies. Now, there is one very critical way in which branded pharma companies differ from, let's say, unbranded companies or API companies or chemical companies, and that is pricing power. So, let's take the scenario for, let's say, 6 months back, right? So, there was raw material inflation coming from China. So, the API chemical companies, so I call both of them in the same breath because both of them generally consume similar kind of materials. So API and chemical companies, they were buying this expensive raw material from China, expensive compared to the past, let's say 5-year prices or 10-year prices. So they were buying this expensive raw material and they were unable to sort of pass on the impact, or they were partially able to pass on the impact to their customers, which is essentially the formulators. Now there are two types of formulation companies. One, those who formulate the products and sell them to unbranded markets. Second is those who formulate the products and sell it to branded markets. Now, the unbranded guys bought the slightly more expensive API, and they were still facing price erosion in the US and European markets, so they had no choice because that is really driven by competition. That pricing pressure has got nothing to do with input cost. The branded guys are able to take some price increases because they're allowed to do so by the legal framework in India. Yet they were able to not hold on to their margins because the raw material inflation was higher than the price increases that they took. Now, going into FY24, what we have at least seen in data and what the companies are commenting, they are saying that the raw material prices have begun to cool off. Now, if that is the case, then what's going to happen is that you will have the API companies and the chemical companies buying cheaper material from China, and that's purely driven by the Chinese industrial activity, which is basically now in full swing. So China's COVID problems are basically behind them. The relocation of plants because of pollution norms, implementation, etc., that all is also behind them. So you are seeing pressure on chemical stocks, right? So that pressure is coming from because China is dumping chemicals into the Indian market, and these chemical companies are finding it hard to compete with them at a price level. So some of them are seeing price erosion, some of them are seeing volume share loss to China, some of them are seeing both. Now, that's going to translate to an intermediate spring probably in the API margins in India. So we saw results of some of the API companies that have already come about. So whoever is a purely generic API company has shown decent results, decent uptick in margins. And that's purely because the acquisition of raw material from China has become cheaper, and therefore their margins would expand intermittently. Now, the formulators for now will not probably show that improvement in margins because they are still buying the higher price API, or they're sitting on the higher price inventory from these API players. But eventually, the formulators would come to know that the API margins are going up because their raw material cost has fallen. So they'll go back to the API companies and say, look, your margins have expanded, your raw material cost has gone down, so you need to pass off some of the benefit to me. So the API companies, after intermittently reporting slightly higher margins, would probably start reporting normal margins again. because they will have to take price cuts to accommodate the request of their customers, which is the formulators. Now, the unbranded guys, again, this price cut in raw material would largely be set off with the price pressure that they will see in markets like US, Europe, UK, etc. For the branded guys, they will still take another round of price increase. So the WPI for Jan to December 22 was 12.2%. So that's the limit of price increase they can take in prices in products which are under WPI or under price control. Products which are not under price control, they'll be able to take up to 10% price increase. So last year, most of these companies took anywhere between 6 to 9% price increase, although they were allowed almost 11%. This year, I'm assuming it will be a similar number between 6 to 9, but that will happen along with the correction in input cost at some point. Now that point could be 1Q24, 2Q24, 3Q24. It really depends on how much inventory, API inventory each of these companies are sitting on. So in my view of the universe, what's probably going to happen is you'll see API companies intermittently maybe reporting better margins on the commodity products, and those margins will then basically cool off. The unbranded guys will basically not have any significant dip in margins because they will have a lower input cost, but they will have a lower price, so immediate lower prices. So their margins would stay where they are. Branded pharma guys would probably see an expansion in margins because their uh, end prices, product prices will go up, but their raw material prices will come down. So the key point here is, therefore, when you look at the multiples of stocks which are largely unbranded generics but are large companies, their multiples are still significantly higher than some of the smaller companies which are largely branded companies. So that begs the question on, is this really what is right, or is this really how the market is today because of the want of liquidity by some of the larger investors, and therefore the larger companies get the benefit of their liquidity rather than the fundamental business that they run? And the smaller companies do not get rewarded for the quality of the business model, but they get penalized for the lack of liquidity in their stock, given the market caps that they trade at today. Because if it's just technical, if it's just liquidity, then over a period of time, as these smaller companies grow bigger, they will have their day in the sun and they will become more expensive than the larger ones at one point. We have seen that happening with a couple of branded pharma companies in the past. We can take names on those because this is historical data. So Abbott India, Torrent Pharma, these are all examples of completely branded businesses which are very, very cheap, let's say 5, 6 years ago, and today are much more expensive than any of the larger weights, like a Sun Pharma or a Cipla or a Dr. Reddy's, which are more unbranded than branded. So the point is that if you're a 5 or 10 year investor, where are you going to be in the two spaces? And that's really, my monologue. I'm more than happy to take questions or doubts or comments because we are here to learn as well. So some of you guys must be connected to the chemical API or pharma industry one way or the other. If you have inputs, kindly do share with us.
Right. So anyone who wants to ask the questions can send in a speaker request or can send in DM or in the comments. Meanwhile, Sajal sir, any inputs from your end?
No, nothing. I mean, Aditya covered it very well. See, the math is very simple in the branded pharma space. The gross margin. What is the gross margin? Gross margin is a function of your selling price and your input cost. And if both are favorable, then there is no reason why gross margin should not expand. So if you look at the equation of the gross margin, I mean, on the selling price is a function of your GDP growth, right? So let's assume it's 6%, and then it's the price rise, the WPI thing that Aditya just explained. So it's a function of two, your volume and price. So that's on the end product pricing front. And then the raw material, which was high in 2021, which was high in 2022, has started receding, and we know what happened to the stock and the economics and the margins of the chemical companies. So the proof is right here. It's all validated. Depending upon how much inventory these branded pharma, most of them are not integrated in the sense that they don't produce their own APIs. They procure API from the market, and the reason their gross margins are significantly high. So 70-80% gross margins are common in branded pharma. So depending upon their suppliers' inventory, they will start to see gross margin expansion. It may not be fully visible in Q1 of this fiscal. It may be starting Q2, but throughout this fiscal 24, the current fiscal, I expect to see gross margin expansion, because if you look at their historic trend, so never go by what was the gross margin last year or the last quarter. You look at the trend line, and in most cases what you would find is that the gross margin is towards the lower end of that band. So they always hover in a band, and the band could be different for different business. So one specific business may have a band, maybe hovering, gross margins may be hovering in the band of 60 to 70%. In another case it may be 65 to 75%. Whatever that band is, most of these companies are towards the lower end of that band. And mean reversion is the most common phenomena in stock markets, and I expect mean reversion to play out in the gross margins going forward. So simple thesis, exactly the same thesis I shared on the January Spaces session that Saurabh was leading, and I just hijacked that session for about 20-25 minutes. We discussed Piramal Pharma in that session, and there was a question on the back end asking, what does China reopening means? And I said, well, China reopening means that a glut of chemicals. Sounds like good news for both the API players as well as the branded pharma players. So that's started to play out already in the stock prices and the results of the chemical companies, and it will hopefully start playing out in the performance of the branded pharma and the API players. Well, we have seen some of the API players report better margins already, but I think it should start playing out sometime in FY24.
Right. So far, like two questions. One is like company specific. The person is asking the view on recent managed commentary by Zydus. So shall we take this question, or move on to next?
Yeah, I don't track Zydus that closely, so I wouldn't be able to comment. Sajal, but if you have any view, you can share.
No, absolutely. I mean, I don't track any of the large caps for that matter, be it Zydus or any other, unless they tell us what that commentary. We're more than happy to analyze. We may learn something out of it. And so, if you know what that commentary is, just put that in the question itself. Otherwise, I don't track it.
All right.
So I'll tell you something though. In the past, I think 4 years back, when companies like Zydus and Alembic were doing fairly good in US, go back and read the commentary then and see what has happened in the last 4 years. You know, that's one way to look at things. I'm not saying that's the only way to look at it. For all you know, there might be factors beyond their capability which impacted performance over the last 4 years. But what I remember clearly is that what they guided 4 years back for the next year, they haven't achieved in 4 years. Now, was that because they they couldn't anticipate some of the changes that happened in the market, or did that happen because they were just too optimistic on something which was just unpredictable? You know, is something that we have to understand. So, which is there's a reason why we don't track some of these largely US oriented companies, is because the management doesn't intend to lie. In most cases, the management actually intends to give you some guidance because you're a stockholder, and everybody on the con call just keeps asking for guidance. So they need to sort of make a statement there to just make sure that the shareholders don't feel that they have not been shared information with. I feel that they give guidance in their best earnest, intentions. Yet they can dramatically overshoot or undershoot the guidance, because the business is such where it doesn't matter how they behave. It matters how the competition behaves. So they can do everything right. They can be vertically integrated. They can launch very, very limited competition products. They can do everything on the dot and yet go wrong with their guidance because the competition just did better. And if that's the case, they're not going to make money. They're not going to grow profits. they will show declines in profit, declines in revenue, and pricing pressure and all of that, despite not doing anything wrong. So you have to understand it. The unbranded generic business model is a model where it doesn't matter what you do. It is important what you do. But what is more important is what your competition does. So really guidance then becomes a matter of perspective on how good a grip on competition do you feel the company that you're talking to has. Now, given that competition doesn't come purely from India, it is from China, from Bangladesh, from European players, from American players. If you put yourself in the company's shoes, how much of a grip can you really have? So yeah, I mean, that's something I wanted to share.
Right. So next question is from Deepak Chande. He's asking margins of intermediates manufacturers like Chemcon specialty going forward. How do we play such cyclicals?
See, how do you play cyclical? The template is the same. You buy them when their performance is below their historic mean, significantly below their historic mean, ideally. And what do I mean by historic mean? I'm not looking at 2 year, 1 year kind of mean. I'm looking at a longer term mean, over so 10 year, 15 year, if possible. The problem with these new listings is, in most cases, you don't have that long term mean data. And more importantly, you don't know much about the promoter, their integrity, their competence, their can you trust them, have they ever walked the talk, that kind of, which is important. So I recently shared my thoughts on Aarti Pharma Labs. So they also make intermediates, right? Um, and I said, they promised to do earnings call. So if you read the Aarti Industries third quarter FY23 transcript, there's a clear mention that they would do the Aarti Pharma would do dedicated investor calls starting Q4. And I was waiting for that session. They published the numbers, but there was no mention of any investor engagement. To me, that's a red flag. And that's the reason I sold, and I tweeted the very same day. So there is no clear cut answer in terms of because there are thousands of intermediates. What kind of intermediate you are making, and what's your history? What are the people behind that business? These are the two prime factors. So if you give me a company that is making an intermediate that is going into an NCE or going into a patented molecule, and I can trust the people, I'm willing to pay them a very high multiple, because I know that there is no pricing pressure. And if I could figure out that this player is either a monopoly or a duopoly, then that gives me assurance on the sustainability of those margins, and the multiple that I will put on those cash flows will be very different from the multiple that I would give to a generic intermediate, which 10 players are making. And because then it becomes a function of purely demand and supply. So commodities, whether they are on the chemical side or the pharmaceutical side, you have to play looking at the supply side more than the demand side, because the demand is a function of global GDP movement, give or take. So demand is given. The only question is whether it will be a good demand or a fair demand. In most cases, pharmaceuticals for sure, because the disease burden is not reducing, the population burden is not reducing. So all that is a given. What is not given is, what I, as Aditya explained, the competitive dynamics. How many players have got the supply, who has got the excess supply? So it's again that same game theory prisoner's dilemma, which I covered in my Alpha Series 25, the part one of that. So I mean, sorry, long answer, but I don't know, unless I know the intermediate, and unless I know the people behind those intermediate, I cannot give any multiple to those cash flows.
Right, sir. Aditya sir, any inputs you want to make, or shall we take next question?
The next question, Chemcor, I don't track that. Right?
So Shankar is asking, is there any indication of reduction in pricing pressure in US, or it's more or less same as it used to be?
Yeah, this I will take care. This is a very good question, and I think this is a question that most institutions get confused over. And very interestingly, most of these institutions, when I talk to them and they talk to me, and they say, Aditya, why aren't you getting bullish on unbranded generics? Pricing pressure is normalizing or it's abating, right? So I basically take a pen and paper and I show them what they are telling me. Okay, so I tell them, let's say this is year zero, a product is available at $100 a box. Now, next year, year one, there was 15% price erosion. There was steep price erosion last year, right? So let's say 15% price erosion. So that went to $85. Right now, you're saying pricing pressure is easing. Okay, so it's no longer 15%, it's 5%. So $85 this year will have 5% price erosion. So you will have the product price at $81. Right? Do you realize you're still cutting prices? Do you realize this means your margin will still fall? Do you realize your revenue will still decline? Do you realize you still need to launch more products to grow revenue? So it's a treadmill, right? So if pricing pressure is normalizing or it is steep, it doesn't matter. As long as it is pricing pressure, it is not something you should invest in. You should invest where there is pricing inflation. That is what branded generic pharma is about. There is price inflation. In the last 20 years, there has been only 1 year when pharma companies in India have cut prices. That was 2018 because then the WPI was negative and the government made them cut the price because the government says that the products which are covered under NLEM, I allow you price increases when there is positive WPI. So when there is negative WPI, you need to cut prices as well. So that's the only year in the past 20 years when India had a negative WPI, if my memory serves me right. That was the only year. And the companies cut prices only for those products which were under NLEM because the government made them do it because WPI was negative. So whether in US pricing pressure is normalizing or not, it is immaterial. As long as you hear there is pricing pressure in US, run away. Don't invest because then you are investing in deep hope. Very deep hope, very optimistic. As an investor, you need to be to invest in a market where there is pricing pressure. And why do you need to? I don't understand. Why do you need to? Is this the only sector where you can invest in? Within the sector, is this the only subsegment where you can invest in? No, na. Hospital, diagnostics, branded pharma, CDMO of innovators. There is price inflation everywhere. Why would you invest in one subsector which has pricing deflation, which is the generic, unbranded generic business and the ancillaries of unbranded generics, which is unbranded API, commodity API, or commodity chemicals for that matter? Why? Just because some of the larger names that are familiar to you belong to this segment, right? There's a familiarity bias. You know what Dr. Reddy's is, you know what a Sun Pharma is, you know who a Cipla is. So for that familiarity, thanks to the familiarity, you would invest your hard-earned money in stocks and spaces where there is pricing pressure, where every year they have to cut prices. Anyway, sorry, a bit of a rant, but I don't understand the logic, honestly. I don't.
Right, sir. So next question is like question related to Hikal CDMO segment. Is it a mix of patented molecules from innovator, technology transfer here basically, an NCE pipeline?
Sajal, bhai, go for it.
No, definitely. I mean, you also chime in, Aditya, because I know you track it. The answer is in the third quarter FY23 investor call. I asked this specific question, and management answered that with full honesty. In my view, they said that their business model when they started. So I challenged them. I said you have been in this CDMO space for good 12, 13, 14 years, and your margins are still not looking like what they should be for a CDMO player. So they answered it in detail. It's there in the transcript. I don't remember it verbatim, but I can give you a sort of I can paraphrase it. They said that when they started, their business model was more like a CRO, clinical research organization. They were not into the development. So the key component in CDMO is the D. Is D for development. What does it mean? It means creating something new, collaborating with the innovators, their scientific team, and creating something which doesn't exist today. Right? So D is the critical component. Most companies in India, they call themselves CDMO. They are actually a CMO. They manufacture. They don't develop. So they don't have that scientific competence or capability to develop. The marks are for the development. So coming back to Hikal, they said they changed their business model about 4 or 5 years ago, and the results will be visible going forward incrementally. So there will be a slow ramp up in this business. Unfortunately, it takes 7, 8, 9, 10 years to get to some sort of a decent scale. You look at any of the companies that are listed in India or in China for that matter, it took them some time before they started scaling up. And the D in pharmaceutical is not the same as D in agrochemicals. Agrochemical is easy to develop a molecule. Even when the molecule is off patent, the margins are protected because they are very. The competitive landscape is very different. You have got 4 or 5 big players who control majority of the market, and they have got monopoly or duopoly in most molecules. So even if the molecule is off patent in agrochemical, the margins are protected. So you may get away calling yourself a CDMO, and you may be just manufacturing generic off patent molecules. The story on the pharma side is very different. A, it's very difficult to synthesize a novel drug. Then B, it takes a hell lot of time to move a molecule from phase 2 to phase 3, because the volume increases when you move from phase 1 to phase 2 and eventually to phase 3. So read that transcript again. Hikal has got few NCs already in the Japanese market, intermediates, um, and the pipeline should incrementally get better over a period of time. So don't. This is not a business which you can play for the next quarter or even for the next year, for that matter. Plus, there is this legal battle that is going on in the background. So unfortunately, that will not help the valuations. So keep that in mind. There are other companies in the CDMO space who don't have any of the legal sort of overhang, and where the pipeline is much more scaled up, right? And we saw that what happens to your margins when you start commercializing. The 13-14% margins will go through the roof. Margins are very different when you start utilizing your capacities, and the shipments start happening. So you need a lot of patience, but I believe the responses that the management gave on the last call were decent. They were clear, they were candid, and they were open and honest. So I'm hopeful, but it's a fast moving space. Every quarter you need to listen to what the management is telling you, what the numbers are telling you, and then you recalibrate your thesis accordingly.
Right, sir. So Abhishek Kohli is asking beta drugs. They are into oncology and recently entered into dermatology space too. They have done great historically and guiding to 25 to 30% CAGR for next 3 years. So if you have any views, please share around this.
So I mean, Not specific on beta drugs, because I don't think I've got any sort of real insight into this business. I actually don't like companies who give concrete guidance. Um, that's my sort of default setting. um Vague guidance is fine, that so come some companies, like RPG Life, they give guidance saying that they will attempt to grow faster than the Indian pharmaceutical market. I think that's a better guidance, because then you are tied to the growth of the market, and you will aspire or aim to do slightly better than the market. Giving a guidance of 30% CAGR. So on a low base, 1 year you can do 30%, but doing 30% every year, because your hurdle rate keeps increasing. So that's one. But coming back to the business as such, so again, no specific view on beta, but I tend to look at companies in the pharmaceutical space, the branded companies, in terms of the number of moving parts and the regulatory dynamics. So if there is a business which is operating purely out of India, so the geography is one, which is India, the business is branded, and there is no US FDA overhang because they don't operate in the US market. So the number of moving parts are very limited. The Such businesses are simpler to understand, they are more predictable from a cash flow perspective. So I like allocating in those pockets where the number of moving parts are less, and the regulatory overhang is not there. And when I say regulatory, I mean purely US FDA, because that's where most of the parties have been spoiled. Compare this example where they are operating out of India geography, branded medicines, with purely in India, with someone like who is globally diversified, and majority of the cash flows are coming from US, where there is pricing pressure, and also there is a regulatory overhang all the time. So the number of moving parts are far too many, because you don't know how the competitive landscape would shape, what sort of price erosion will happen next year, because then you need to double your run rate in terms of launches to counter that pricing pressure, and then the regulatory overhang is a given. You can get slapped any day. So the business, um, beta drug may be a much simpler business, and again then you look at what's their margin profile over a period of time, what's their ROCE, what's their ROE. If those numbers are above 20%, then and the margins are above 20%, then yeah, it sounds like a decent business. And if you are getting that kind of a business at about 2 times sales, I don't know what the valuation of beta drugs is, then probably on on the basis of these numbers alone, that there should be a value. And of course you need to just do your due diligence on the promoter side. And so if the key question is, are they doing quarterly or 6 monthly investor calls, because you get a lot of inputs, um, because the management cannot be prepared. The questions are being asked, just like we are having this session, right? I don't know what the next question would be. Exactly like on a conference call or on an earnings call, the management, you can catch them off guard. So these investor calls are far better than your annual reports, because annual reports are created by design. There's a lot of marketing jargon that goes into annual reports, so investor calls are better. And again, that Aarti Pharma example that I gave, right? So not doing investor call is a red flag for any company, because otherwise how can you validate the management? Oh, I hope I've given you enough sort of pointers to progress with your own due diligence.
Right, sir. So Shankar is again asking one question, although very generic, discussed previously as well, but I would like Aditya sir to give 1 minute to this. So, I mean, he's asking like views on companies of the likes of Ajanta Pharma, Alchem, Indico, who have both unbranded and branded. How should one look at this?
So look, so most of these pharma companies are present in both export and in India. And export by and large tends to be unbranded, not for Ajanta though. Ajanta's majority exports are actually branded. But they do have a small US business. I think about 10% of their sales is in the US. Similar kind of number for Alchem, I think slightly higher, maybe 14-15% of Alchem's top line is also in US. But these are largely branded companies. So when you buy an asset, you're buying the cash flow, right? So when you buy the stock of Ajanta or Alchem or anything similar, Torrent in that same bucket, you are essentially buying, let's say, 100 rupees of cash flow. In that 100 rupees, 95 odd rupee cash flow is anyways branded. There is either a 5 rupee unbranded cash flow or there is zero unbranded cash flow because as of today, my understanding is none of these companies anyways make any money in the US market. So whatever cash flow you are buying, because it is coming from a branded geography from these companies, it is anyways going to be sustainable cash flow. The problem happens is when it's the other way around, when there is 60-70% cash flow or profit or whatever coming from the US or Europe or UK, and then that is subject to volatility depending on pricing and market share and what have you, right? So that is where the problem is. So in my personal opinion, assets like Ajanta, Alchem, Torrent, which have very, very small presence in US, although I would not want even that smaller presence, but they have it. They experimented, and most of them today realize that that experiment has gone wrong. So most of them aren't really investing more in US. They are rather curtailing the product portfolio, curtailing the capex and R&D they are earlier doing in US. So I'm more than happy to sort of evaluate these companies because they fit in my framework of buying largely branded cash flows.
Right, sir. So next question is from Vaibhav. He's asking about Jubilant Ingrevia. He's saying OPM margin, I mean operating profit margins are going down and down. Can we see the bottom of margins is near, or any view from Sajal sir is asking?
No, so I think I recently disclosed that I have left Ingrevia. My change of stance is more of a function of management change rather than the margins. I mean, I think the margins where they are on the lower end. I will not be perturbed looking at their margins because they are on the lower side, give or take. How fast the margins will recover again is a function of what's their input and what's their output. I'm not honestly speaking, I'm not worried about Jubilant Ingrevia's margins from here on. I'm worried about the change in strategy because there is a new management. I know people have said that it's an existing person, but I don't know what I don't know. I've never interacted, so we need to see what kind of execution happens from here on. And why take that chance? Why take that risk? Um, so on that basis, I'm not in Ingrevia, and I disclosed that I think couple of days back. If you go through my Twitter timeline, you would find that tweet. And but yeah, direct answer to your question, if you're purely asking for margins, I think the margins are where they are, and they should mean revert to at least a mid-teens type of operating margins, if not more.
Right, sir. So next question is from Vishal Rajole. He's asking the recent results of DMCC. Do you have any views on that?
So the results are in line. I was on the call yesterday. Again, I like the management because they are open and honest in terms of they share whatever they can, other than the strategy, of course, because you don't know who else is listening to that call or who would listen to the recording. Their opening line itself kind of settled the score. They said that the China is back in production mode. So the China is back in production full time, but China is not back as a consumer. Now, what does that mean? Again, it means that there will be a bloodbath in the pricing. Because, see, when the lockdown happened in China, the last one, it was kind of unplanned. So there must be inventory lying in those chemical plants, but they couldn't do much about it because the lockdown happened abruptly. So as soon as the lockdown was lifted and normalcy returned, their first priority was to liquidate inventory. And when you want to liquidate, because if you don't liquidate, there is a sell by date. Assume that there is a sell by date, and if you don't sell it, you get zero. So it doesn't matter what was your manufacturing or production cost. If something is lying in your inventory which will turn zero in couple of months, even if your manufacturing cost was 25, you would dump it at 5, 10, 15, whatever you can get. So, and we saw that dumping. It's globally, it's happening globally. India just happens to be one of the destination. There is nothing targeted against India. Then once they have um, they got rid of that inventory, they will start producing at normal pace. And because these plants are large plants, they would like to operate them at scale, their design scale, which means that they would be producing a global scale quantity of any intermediate or KSM for that matter. And if the local consumption is not what it should be normally, then they have got no choice but to continue exporting more than they would otherwise. So that's how the dynamics always work out in chemicals. Unfortunately, again, it's always a game of demand and supply. And this is exactly what DMCC said. And there is a misconception with many investors that they think that there is, if something is a specialty chemical, that is a gold plated. See, a specialty chemical does not mean monopoly chemical. Specialty chemical does not mean duopoly chemical. A specialty chemical may not be an oligopoly chemical. So you may be making this chemical and it's a specialty, but five other players may be making that the same specialty. Then again, it depends on the demand supply game, and how competitive you are. So I asked towards the end of that session, I was fortunate enough to be given the opportunity to interact with the management, and I asked few questions about this. So DMCC, they visit CPHIs. So they've got they are into intermediates of pharmaceuticals, and I asked, anything you could share from the recent CPHI in Japan. And the management shared a very interesting data point. They said that Japan has got a vested interest to partner more with India, and they are getting closer and closer with India. But they still look at Chinese prices while negotiating with the Indian suppliers. So the Japanese customers, they want Indian values at Chinese price. They want the best of both worlds. So there is a fair bit of pressure, even on DMCC. My best guess, and again it's a guess, and I have a vested interest because I'm invested in this business, and I don't have any sort of exit strategy as such, because I like the management. My guess is that the second half of this year should be better than what we have seen in the FY23. It may not be fully reflected in Q1, it may not be fully reflected in Q2, but at some point in the current fiscal, um, the numbers should start looking better. Because one important takeaway from me was that the volumes are up 60% YOY, and yet the the top line for, so if I compare Q4 of FY23 with Q4 of FY22, even despite doing a higher, significantly higher volumes, your top line is lower. So no rocket science, right? The pricing equation has changed, and we need to see, because it's a mix of, so they do sulfuric acid, which is a pure commodity, and they have some specialty component. So whatever margins we see is a blend of these two, plus of course the capacity utilization. So assuming that they are able to ramp up their, so they've done a lot of capex in recent years, assuming that they ramp up their capacities, and the pricing environment turns benign, the margins should improve in the current fiscal, but there is no certainty in this business. So you should listen to that call. The recording is there. um, they shared the recording on the BSE. It's also on YouTube. So if you go on YouTube, if you just type DMCC con call, you will get the recent one which happened yesterday. Listen to that, and you should be able to figure out, whether this is the kind of business that you should be looking to invest.
Right. Another interesting question is the person Srinath. He's asking like a 2,000 crore capex company is guiding, especially in green way of manufacturing first line defense molecules like paracetamol and metformin. So, will this enzymatic route be commercially viable? What are the pros and cons of this story?
So I think it's the right approach. First of all, you have to decarbonize. So Industry 5, right? So the biotech webinar that we had in 2021, Industry 5 is happening. So I'm not sure if you heard the news announcement from Praj Industries and Indian Oil Corporation, the sustainable aviation fuel one. So that it's started happening, and it's an irreversible, whether you like it or not, this Industry 5 sustainability drive is an irreversible process. You will be, so there's a gun on your head, you have to do it, because the innovators and the partners in the European region, they are forcing each and every supplier to go green. So you have to do that. So this is not a choice, and the pressure will be there increasingly, getting worse and worse. So what they are doing in terms of securing their backend through the green chemistry route is absolutely the right thing. The problem with working with enzymes or any new technology is in the scale up at the commercial level, and we don't know. There are always, certain risks, and you may not get it right in the first iteration. But then if you have done enough sort of validation batches, which management seem to confirm that they have um, done this in their labs, you should be able to crack it in the second or the third or the subsequent iterations. But this is not something that will start to play out from the next quarter. So as things stand, majority of the cash flows are coming from handful of products. Paracetamol is one of them, and then there are few other prime molecules. So their immediate focus is on securing their end-to-end supply chain control. So purely the disease model, play in handful of molecules, but control the full end-to-end value chain, and maximize your profit share of that value chain. So I think it's something which is about 2 years out. So leave fiscal 24, leave fiscal 25. um, we have to see, what the picture or the story is looking like starting fiscal 26, because that's around the timeline when the enzymatic and the biomanufacturing results should start playing out. And then it would just be a function of how quickly they can scale up. But I think their bigger opportunity should be longer term, because if they could crack this backend in the green chemistry, there is a wide market in the renewable green chemicals, which, and this market is much bigger than the pharmaceutical market itself. So that could be the longer term game, but this is not a 5 year game. This is kind of a 7, 8, 9 year game. And as we know, there are many a slip between the cup and the lip. So let's see how the story starts playing out from fiscal 26, and then we'll track it from that point.
Right. So, Aditya sir, one quick question is what is the impact on agrochemical and agri input companies due to the projected El Nino effect in India?
So look, this is very interesting. Normally, intuitively, you would say that El Nino or a slightly lower than normal monsoon would create lower demand for agri-chemical products, right? But we did this exercise for last 10 years, And we didn't look at operating numbers, we actually looked at stock prices. So the stock prices of all these agri-related companies, be it seed producers, be it pesticides, be it agrochemicals, fertilizer, these stock prices showed zero correlation with the level of rainfall and El Nino. So I know there is always a lot of talk, and the stocks react also with regards to how the monsoon is going to be, whether there will be a storm like an El Nino, some disruption or the other. But the stock prices have shown zero correlation to any of these events. Above normal monsoon, a normal monsoon, a below normal monsoon, and an El Nino or no El Nino. There is absolutely zero correlation. So I would say, intuitively, uh, the question is correct, and intuitively the demand should be lower. But stock prices don't seem to suggest any correlation.
Right, sir. So there are two, three questions around recent developments in Gland Pharma, in the sense like it got dropped. So some people are asking, at some point in time, would it be a value buy, or the business economics is? I mean, what's the broad view? If although it was discussed previously as well, but just in case you want to add anything to it.
So I would say again the same thing here. So first, in my view of the world, in my personal opinion, Gland Pharma is a commodity company. They can write CDMO as many times as they want and talk about CDMO as many times as they want. They are a CMO for generic, by and large. I mean, 95% or so of their revenue is generic. So that is one. Now, if you are an unbranded generic backend guy, a manufacturer of unbranded generics, then the question begs as to when do you buy them? You buy an unbranded generic pharma company when it is either negative ROE or low single digit ROE, because then you can hope for some mean reversion. As it is today, I think the steady state unbranded ROE that one could expect, given what is happening in US, uh, is around 9-10%. I think that is a steady state ROE. So we need to buy companies when they are doing 2% or 3% ROE, in the hope that they will go back to 9-10% at some stage. And as an investor or as an entrepreneur or as a CEO of that company, you are helpless because you don't know what will happen, because you don't know how many competitors are coming, when they will come, which products will come, how much pricing will be cut, how much market share you will lose. All these are variables that will impact your ROE. But all these are variables you can't even guess. So I feel bad for companies that have gotten stuck into this business, because this business used to be a very good business in 2010 to 15. But these companies got extremely greedy in that period. And because they got greedy, today they are paying the bill of that greed. And the competition is intensified so much that there is only fear. There is no greed left in the business. So, yeah, without specifically commenting on Gland, I'm basically making this comment about the subsegment itself.
Right, sir.
Yeah, absolutely. And just to add on the CDMO comment, and that was a joke. I mean, and investors believing that is a bigger joke. And when I say investors, I'm talking about the bluest of blue chips as far as the institutions of this country, great country, are concerned. They are great minds, very sharp analysts, very sharp institutions, and everyone believed that story, and no one cared to look at the gross margins of the business. A high quality CDMO business should be doing a high quality gross margin. So you compare the gross margins of Syngene, 70% gross margins, right? That's a high quality CDMO.
No, I'll give you another point.
What are the gross
I'll give you.
margins of Gland? 50%. Yeah, sure, Aditya.
Yeah, I'll give you another point. So, gross margin was one indicator. Look at the asset base. Boss, innovator quality CDMO is low volume, high value. The quantities that Gland was making to make the revenue, the kind of gross block they had, and the kind of expansion they had announced, that doesn't correlate to an innovator model. That only correlates to a generic model where you can have that kind of insane volumes. So your asset base, your asset turn, also reflects on the kind of business model you are running. Is it high volume, low value? Is it low volume, high value? Innovator business will always be low volume, high volume. When I say always, 90%.
Absolutely. And then people were paying top dollar. I mean, the valuations that people were paying around the IPO time and even after listing, there was so much positive chatter and carnival around this. The valuations were ridiculous because, again, you are assuming that 35% operating margins are sustainable, and so you are giving a very high multiple to those margins. What actually happened was the margins started crashing and the multiple also started crashing. So that's a double whammy. What you should be playing is on the other side. You buy a business when the margins are 15% and one time sale, and the margins go to 30% at 4 times, 5 times sale. That's how you make a 10x. The Gland example is the reverse 10x, reverse
I think
compounding.
the I think the QIB book of that particular IPO was subscribed 20x plus. 20x.
Exactly. So see, people are investing retail ka paisa. So institutions, they don't have their own money, na. They are investing someone else's money. So read Skin in the Game from Taleb. Most people are interested in reading, random books, and you should read Skin in the Game. There was hardly any skin in the game. You're not investing your own money. You're not investing your granddad's or your dad's pension fund into it. There's no pressure. So you just is herding the neighborhood investor in the mutual fund guy. He has done the due diligence and he's parking 500 crores in there. I mean, I can do 100. That's the game. It's just purely mugs game.
So, sir, we take one last question from Shubham. Shubham, quickly unmute and keep your question, please.
Hi, sir. Namaste, Sajal sir और Aditya sir. Am I audible?
Yes, Shubham, you are. Go ahead, please.
Yes, sir. Sir, दो questions थे. Again, थोड़ा late join हुआ मैं sir, तो I don't know if it has already been covered. Sir, पहला question था कि I think so China is opening, right, sir? So इधर मेरा just एक ये था sir कि there are three categories, right? I mean, China opening के वजह से some players will suffer, some players will actually it's beneficial for them. तो beneficial तो clear है sir. जैसे आज even commodity chemical crashing is better for say branded generic players, right? It is better for all the players जो अपना रॉ मटेरियल उधर से इंपोर्ट कर रहे हैं सर लेकिन इट इज बैड फॉर प्लेयर्स से जो चाइना को एक्सपोर्ट कर रहे हैं और जहां पे वो कंज्यूम होता है एंड सर अगर मैं फाइन प्रिंट पढ़ रहा हूँ आई वाज रीडिंग द कॉन कॉल्स ऑफ डीएमसीसी दीपक नाइट राइट तो वो लोग एक बात ये बोल रहे हैं कि द सप्लाई हैज कम बैक मतलब सब मैन्युफैक्चरिंग चल रहा है बट द कंजम्पशन हैज नॉट कम बैक येट तो प्रॉब्लम ये मैं सोच रहा हूँ कि जो फॉर एग्जांपल अभी चाइना को जैसे सुप्रिया लाइफ साइंसेस हुआ हेरानबा हुआ जो Q3 में उसके वजह से सफर कर रहे थे सो will these players now because हम ये सोच anyways Supriya and Heranba they were saying that the recovery in demand from China will come in like 2-3 quarters. I mean it will not come the next quarter. But I don't think मतलब there are players who are also benefiting and also who are suffering will suffer as well. तो वो था उस पे व्यू पॉइंट लाइक आपका क्या व्यू पॉइंट है सर सेकंड क्वेश्चन ये था कि सर ये ना बहुत ही अजीब लगा मेरे को सो आई वाज हैविंग अ डिस्कशन विद माय फ्रेंड एंड तो बेसिकली हम लोग सीडीएमओज में देखते हैं लार्ज सीडीएमओज में देखते हैं चाहे वो आप बुक्स ही ले लो आप इवन एनी बिग सीडीएमओ तो कैपेसिटी अपफ्रंट लगाना पड़ता है मतलब इनोवेटर तो ये नहीं आके वेट नहीं करेगा ना कि आप पहले वो मॉलिक्यूल के साथ आएगा फिर वो कैपेसिटी हम लगाएंगे फिर ये करेंगे इट शुड बी रेडीमेड बिकॉज फिर उनका टाइम उधर टिक हो रहा है तो सर तो उसने ये बोला अरे ये फिर ईपीसी कंपनी से अलग कैसे बिकॉज ईपीसी कंपनीज में भी कैपेसिटी चाहिए so I said that is a very weird way of looking at it because I think a lot of people have this misconception. Even मैं seasoned investors में भी कुछ देख रहा हूँ कि capacity जो upfront लगाने का scene है वो they are saying that it's a wrong thing. But I think so मेरा understanding ये सर मैंने जो बोला उसको कि see capacity लगाने पे हाँ the capacity utilizations will drop off. पर end of the day the margins are so high for the products the stickiness that you get with the customers it compensates for very high ROC मतलब आपका margins, क्योंकि ROC is a component of margins and also capacity utilization. So even if you are putting up capacities and the capacity utilization always remains low, still मतलब ROC will remain great. I mean that's very मतलब यही है सर कि I think so इस पे थोड़ा आप elaborate करें, because many people are thinking that ये capacity लगाना पड़ता है तो it's like a, I think it's a barrier to entry. मतलब because capacity लगाएंगे तो competitors cannot easily enter this space. तो सर यही मतलब बिकॉज आई थिंक फॉर एवरीवन इट विल बेनिफिशियल, बिकॉज ये जो सोच रहे हैं कि कैपेसिटी लगाने पे प्रॉब्लम है, दैट वाज व्हाट माय व्यू पॉइंट वाज, एंड इफ यू कैन ऐड टू दैट आल्सो सर, एंड आई डोंट नो इवन इफ माय व्यू पॉइंट इज करेक्ट और नॉट. सो यही दो क्वेश्चंस है सर, एंड यही था सर, लाइक दोस टू क्वेश्चंस सर.
सो आपके जो पहला क्वेश्चन था शुभम, उस पर तो आई थिंक हम लोग ऑलरेडी डिस्कस कर चुके हैं. यू आर राइट, ब्रांडेड फार्मा कंपनीज विल बेनिफिट बिकॉज उनका एंड कस्टमर रिटेल कस्टमर है. रिटेल कस्टमर जाके उनको नहीं बोल सकता है कि तुम्हारा कॉस्ट घट गया, तुम मेरे दाम घटाओ. देयर इज नो वॉइस. इनफैक्ट देयर इज अ लीगल फ्रेमवर्क वेयर दे आर अलाउड टू इंक्रीज प्राइसेस. तो वहां तो कोई सवाल ही नहीं उठता कि अगर उनका कॉस्ट कम हो गया तो वो अपने प्राइस कम करेंगे. नहीं करेंगे, कभी नहीं कर सकते वो. दे नेवर कट प्राइसेस अनलेस द रेगुलेटर टेल्स देम टू कट प्राइसेस. रेगुलेटर तभी बोलता है जब डब्ल्यूपीआई नेगेटिव होता है. तो इस साल तो डब्ल्यूपीआई 12% पॉजिटिव है. So there is no way that the branded pharma companies will correct prices. And उनका रॉ मटेरियल कॉस्ट तो गिर रहा है, क्योंकि उनका रॉ मटेरियल जो बनाता है वो अपना रॉ मटेरियल चाइना से लाता है. सो चाइना से अगर आ रहा है माल उसका सप्लायर का, तो सप्लायर को बोलेगा भाई अब अपने दाम घटाओ क्योंकि तुम्हारा रॉ मटेरियल का दाम घट गया है. सो दैट आई थिंक इज वेरी क्लियर. ऑन द सीडीएमओ साइड सजल भाई विल ऐड मोर, बट मेरा पर्सपेक्टिव ये है कि एक तो ये सोचना कि सीडीएमओ की कैपेसिटी अपफ्रंट जा रही है वो सही है, ईपीजी में भी जाती है वो भी सही है. ईपीजी में कस्टमर तुमको एडवांस देता है क्या कैपेसिटी डालने के लिए? कस्टमर को फंड करता है क्या तुम्हारा कैपेसिटी? कस्टमर तुम्हारा ऑर्डर बुक भरता है क्या 3 साल का 5 साल का? सीडीएमओ में ये सब होता है. दैट इज हाउ आई फील इट इज डिफरेंट. बाकी सजल भाई कैन ऑब्वियसली ऐड.
No, exactly. That was exactly the point I was about to make. कि कस्टमर एडवांस दे रहा है क्या, या कस्टमर साइन करके दे रहा है कि अगर मेरे कहने से कैपेसिटी आप लगा रहे हो, लेकिन अगर मैंने कॉन्ट्रैक्ट कैंसिल किया तो मैं आपको पैसे दे के जाऊंगा. तो मैं एग्जांपल देता हूँ बड़ा पुराना. बायोकॉन ने मलेशिया में फैसिलिटी डाली थी फाइजर के कहने पे इंसुलिन की. फाइजर मूव्ड आउट ऑफ द डील और 200 मिलियन का चेक थमा के गया था वो बायोकॉन को. 200 मिलियन. तो पूरा का पूरा प्लांट जो है ना मलेशिया वाला, उसका फेज 1 फाइजर ने फंड किया था. वो होता है. अगर आपको वैसा कुछ कमिटमेंट दिख रहा है कि अगर तू कॉन्ट्रैक्ट कैंसिल करेगा मिस्टर इनोवेटर, यू विल पे मी पेनल्टी, then I can do whatever, and as long as my capacities are fungible, then I can always use that to make any molecule, and वो मेरे लिए आगे कहीं और काम आ जाएगी फैसिलिटी. अगर उस टाइप का सिनेरियो आपको दिख रहा है तो वो एक एंगल है. दूसरा एंगल है कि आपका जो प्रोडक्ट है वो एग्जिस्ट नहीं करता है टुडे. ठीक है, बल्ब नहीं बना रहा हूँ, ट्यूबलाइट नहीं बना रहा हूँ, एडिसन वाला काम कर रहा हूँ कि जब बल्ब था ही नहीं. So Edison tried thousands of different filaments. That is development. And development is a ridiculously high margin. The gross margin of development is 90, could be 95%. Because development is the science. Once you have done the development, you have filed the NDA for authorization, then tech transfer route can come into play, and any competent player can do the manufacturing. So that is why for the same molecule, the manufacturing will always be a lower gross margin. So the gross margin in manufacturing will be 60-70%. Whereas in development, the gross margins were as high as 95%. So development in phase 3, development in phase 2 is a very high gross margin business. And if you find that the other industry, the examples that you quoted, are also creating something new which doesn't exist today, then by definition it's a CDMO, because the D of the CDMO, most people confuse. I keep saying that they think that CMO and CDMO are same. It's not job work. It's the development. You're developing something, you're collaborating with the engines of the world to develop something that doesn't exist today. You are engineering these living organisms. That's where the science is. और उसी बात के नंबर है. I hope that
right, sir. So Shubham, thank you for your questions. Apologies, like short on time. There is another session, great session on bill and estate planning, which is going to be very useful for every individual because succession planning and family wealth, how it's on to next generation is a very relevant topic for everyone. So thank you, Aditya sir and Sajal sir, for your time, and uh, surely we'll take the remaining questions in next interaction. Thank you.
Sure, sure.
Thank you,
Enjoyed
guys,
this.
and remember disclaimers.
Yeah. Thank you, Aditya sir, for joining
Yeah,
on
exactly.
such a short
No
notice. Thank you both. Thank you.
recommendation. Thank you. Bye bye.